All right, so in the previous video, we discussed the fact that there's rarely a situation, almost never, where we sell a $1,000 bond for $1,000. Or if we were a purchaser, we would almost never pay $1,000 for a $1,000 bond. Okay? Because by the time these bonds make it to where they're for sale just generally to the public, the interest rate is almost certainly changed. Okay? So, we said in the previous video that when we sell bonds for less than the face amount, they're issued at a discount. And when we sell bonds for more than the face amount, those bonds are issued at a premium. However, we have to think about the mechanics of this. And so what we have to acknowledge is that whatever the face amount of the bond is, that's what we're going to have to pay back, okay, to the investor. So think about it like this. We had the example of the $1,000 bond that was discounted. It was sold at 98, and so that means we would get $980 for it, right? But our liability is for $1,000. So if we think about this from a balance sheet perspective, we're getting cash of $980. Okay? And what we would say is that getting cash of $980 does not equal the liability, the bond payable of $1,000. So what we have to do, we can't mess with the cash. We got $980, so we have to bring this $1,000 over here as a liability down to kind of artificially down to $980. Or in the other example, we got $1,090 for the bond. We would have to bring the liability kind of artificially up to $1,090. Okay, so that's confusing. I get it, but just stay with me here. Let's go ahead and get this out of the way, though. When bonds are issued at the face amount, we don't have to do any of that stuff. The face amount of the bonds, this is a bond issue. There's probably be 100 different bonds, is $100,000. The contract rate of interest is 12%, and then notice here the market rate of interest is also 12%. Incidentally, the term of the bonds is 5 years. Well, the face amount is $100,000. Market rate of interest, contract rate of interest are the same. We can actually sell these bonds for $100,000. So we're going to get $100,000 cash, that's our asset, and we would simply set up a liability, bonds payable for $100,000. Again, this doesn't happen very often. And here's the journal entry, we just talked about it. We get cash for $100,000 and we have bonds payable for the same $100,000. Unfortunately, this is simply not the way it usually happens, okay? But we do need to go ahead and go over bonds issued at face amount. In your homework or as you're reading through your textbook, you may also see language referring to this as bonds issued at par, P-A-R, okay? That just means that these two figures here, the cash received and the payable, are going to match to the penny, okay? Bonds issued at face amount or bonds issued at par. Okay? Now, we had a contract rate of 12%, but remember we said that usually interest is paid every 6 months. So it says here every 6 months on June 30th and December 31st, because those bonds were issued on January the 1st. After the bonds are issued, interest of $6,000, that's $100,000, the amount of the bond issue, times 12% times a half of a year, or 0.5, is paid. And then says the first interest payment is on June 30th of year 1, and it's recorded as follows. We're going to recognize interest expense. Expenses are always a debit for $6,000. Cash is our asset which is going down, so we're going to credit cash for $6,000. Okay? Now let's fast forward into the future a little bit. It says at the maturity date, well, if we recall from a couple of slides back, this was a 5-year term. So this is a pretty profitable little investment here. We're going to get $6,000 every 6 months for 5 years. That's quite a bit of interest. And then at the maturity date, we're also going to get our principal back. So this is how we clear this entry up here where we're just paying the interest. This does absolutely nothing to reduce our liability. Our liability is still $100,000. But year 5, right here, December 31st, end of the year, we pay back the full principal amount of the bonds, and so we debit bonds payable for the $100,000. We set it up with a credit. Now we're getting rid of it with a debit. Cash is our asset that's going down, so we're going to credit it for $100,000. Okay, and at this point, the investor, the bond investor, has received all of their interest, and they've received all of their principal back. All of their principal is back in their pocket. Okay. However, we said that almost never happens. So here we have basically the exact same situation. Face amount is $100,000. The contract rate is still 12%. Interest is still paid semi-annually on the same 2 dates, and the term of the bonds is still 5 years. However, notice that the market rate of interest has now changed. It's now 13%, so interest rates are going up. So we need to recognize right away, if we're the person trying to sell this bond or the company trying to sell this bond, we're paying less on the bonds than what an investor can get on the open market. So how do we make that up to them? Let's look at one more example here. And then we'll come back to that. It says, illustration, assume that on January the 1st of 2022, Candlestick sells 100,000 5-year 10% bonds at 98% of face value with interest payable on January the 1st. The issuance is recorded as follows. And this is not a journal entry, but notice we're getting $98,000. This is our asset. Our bonds payable is $100,000. So what we're going to do is we're going to use this discount on bonds payable here as a contra account, a contra liability account, and we're going to subtract it from the $100,000. That way our assets, $98,000, equal our net liabilities, the $100,000 for the bond minus the $2,000 discount, and our balance sheet balances. Okay, so here we have it. This is a partial balance sheet to illustrate just that. We got $98,000, so we must use the discount on bonds payable as a contra liability to make our net liability $98,000. Okay, so here we have a situation where we have issued a bond at a discount. We didn't get $100,000 for it, but it was a $100,000 bond issue. So notice our bonds payable amount here is still $100,000 because that's the face amount of the bonds. We received $96,406. So I want to just show you something really quickly. these bonds, to use bond terminology, we saw bonds issued at 98. These bonds were issued at 96.406. Okay. Now we probably won't have any examples on our exams or anything where we have a bond issued at 96.406, but sometimes you will see situations where a bond is issued at 96.5 or something like that. So the way we handle this is we know that the bonds payable amount is a credit because it's a liability. Well, and we also know that cash is an asset, so we must debit cash in this case for 96,406. The discount on bonds payable has to be a debit to make the two sides balance. So in the initial entry, we're going to have a debit to cash for 96,406 and a debit to discount on bonds payable for 35.94. These two figures add up to 100,000, and then we're going to have a corresponding credit to bonds payable for 100,000. So on the balance sheet, this cash is going to be over on the assets. The bonds payable is going to be our liability, and then this discount on bonds payable is our contra liability account, bringing basically a negative in front of this to make the two sides match at 96,406. Our liability to the bondholders is still 100,000, but this is a contra account, basically to help our balance sheet stay balanced. All right. So let's see here. Now, did we already have this? Yeah, I think we did. Okay, so let's go ahead and I don't think there's anything different on this page. So let's go ahead and end this video, and then we'll get another one up shortly.